More than half of all candidates fail the Florida real estate exam on their first try. It's not because they didn't study, it's because they studied the wrong way. State exam questions are designed to trick you into second-guessing what you already know. But with the right Florida real estate exam prep, you can walk into your test knowing exactly what to expect. In this video, you'll hear from a licensed Florida real estate instructor who's going to walk you through exam-style questions, breaking down each one so you understand the logic behind the answers. Let's get started.
A father and his daughter bought a commercially zoned tract for cash. It was a cash deal. That's nice. No financing, straight cash. The property was deeded to them, watch this, with full and legal rights of survivorship. What are the father and daughter considered? Or the father and daughter are what? Anytime you're taking an exam and you're reading the question, the technique that I really use for myself, I like to use that word, and you always hear me talk about unpacking. Unpack the question. And what does that mean? Line by line. You got to look for key words and key phrases in questions that will give you the answer. Okay. So, for example, on line 2, we see full and legal rights of survivorship. So we know we're talking about a concurrent ownership or a joint ownership. Okay. Co-ownership. Now, the next thing we know is between a father and daughter. Okay. So there's nothing that says kinfolk can't form a co-ownership in a purchase of real estate. It's not between a father and a wife or a husband and wife, father and daughter, with the legal rights of survivorship. So those are some key words when you unpack and go back and review the question. Be careful about reading one line and tripping to the first answer. Okay. So read the whole question and then go back and unpack and look for key things in the question. All right, here we go. Let's jump back into this. All right, so a father and daughter bought a commercially zoned tract of land for cash. It was deeded to them, both of them. So with full and legal rights of survivorship. So what are they considered? Father and daughter are what? All right, so let's look at this. Again, when you unpack these questions, father and daughter, so we're talking about co-ownership or what the term is called concurrent, 2 or more. And the key word you're looking for here is rights of survivorship. Now remember, father and daughter. Father and daughter is not husband and wife, okay? So if you look at husband and wife, that's a co-ownership, tenants by the entireties, right? Inseveralty means you own by yourself. So this doesn't fit this. And then tenants in common is a co-ownership, but it doesn't have the right of survivorship. So the one that fits this is going to be joint tenants, okay? And so when you look at concurrent ownership or co-ownership, tenants in common, and you want to know this for the licensing exam, because there is a question out there. What co-ownership gives the most protection to the families? Okay, families meaning successors, heirs, wills, people that die, testate, intestate that leave a will, or if they go through descent and distribution. But family members get part of that ownership of that property if there's a deceased owner in tenancy in common. Okay, so basically you own your portion. Watch this. You own your portion in severalty. So you don't have to get permission from the other co-owners to do what you want. You can sell yours. You can make a will out for yours. So it gives the best protection. Joint tenancy gives the least protection because of the right of survivorship. So if an owner dies of that partnership, then the surviving members absorb his or hers portion of interest. It doesn't get willed to a family. So joint tenancy is the right of survivorship. In other words, the surviving members of that co-ownership absorb their interest. Okay. And tenancy by the entirety, I saw one answer up there, is the same thing as joint tenancy, but it's a married couple, husband and wife. Okay, so this is father-daughter. All right, here's a little example I put up here. If you want to take a screenshot of this. If A, B, C, and D come together in one, title, time, interest, and possession, so those are the 4 units that have to be completed, and then D dies in the top right picture, A, B, and C now absorb. So it's 25% when they first go, 25 each, four people equally divided. One dies, it goes to 33 and a third each. And then C dies, it'll go 50-50. And then if B dies, A gets it all and then converts to severalty. Okay? Ownership and severalty. Okay? So we're talking about joint tenancy, okay, which is answer D.
Ready to pass the Florida Sales Associate, Broker, Mutual Recognition, or Endorsement State Exam on your first try? Get our exam prep database that contains practice exams tied to over 1,000 exam-style questions with detailed explanations. Enjoy 3 months of 24/7 access from any device, including desktop, laptop, tablet, and mobile. Click here and use the coupon code YouTube to get a special discount.
All right. Which parties are most involved in the secondary market? Remember, this is under your finance section on how money is distributed when it comes to home purchases, right? How money is leveraged out from financing, mortgaging homes, okay? So which parties are involved in the secondary market? We're talking about the secondary market. So here's how this starts. Ready? Now, I want you to think of this. If you get this concept right here, you're going to get it all. And you got to ask yourself, does a bank ever run out of money? Think about it. If you fill your car up in Florida and you drive to Oklahoma, you think you can make it on a tank of gas? And the answer is no. You're going to have to stop and fill up several times. Well, a bank only has so much money in its depository where they can lend out. When they're full, that's called intermediation. There's a lot of mortgage money available. When they get low, like on the right-hand side, that's called disintermediation. In other words, there's no mortgage money available to lend out. So how do they keep that intermediation or that balance between full and empty? Is they sell the loans. Watch this. The bank makes the loans, gives it to the guy leaning against the house, gives the money to buy the house. Now the bank has a loan. It's called a mortgage. When they get low, the primary market will turn around and sell the loans to the secondary market, which they will warehouse them. And I say warehouse them, it's like a warehouse. They keep the loans and service it out for 30 years. So now the primary market, which is the bank, gets the money back and they'll turn around and lend it out again. So it's kind of a cycle, okay? And so here's the big picture. You see the big red circle, the primary market, they originate loans, and there's your group of people at the bottom left. Those are the people borrowing money. The blue box at the top, the secondary market, will buy loans. That's Fannie Mae, Ginnie Mae, Freddie Mac. They'll buy a variety of the loans from the primary market. That's a way that the primary market gets money back to lend out again. They also, from the green box, can get deposits. Those are you and I that put our savings into the bank. And in the other way, in the gray box, is they can borrow from the federal district banks. And you look at the photo, Atlanta is District 6. Okay, that's where all the banks in Florida can borrow hundreds of millions of dollars in bundles. They call it lots. And they package them in mortgage lots or bundles. And then they'll turn around and sell those loans at a higher interest rate on what they borrow it. That's called arbitrage. They'll borrow from the federal district bank in Atlanta, say for 1.5%, and then they'll turn around and make loans. 3.5%, 4%, 4.5%. The difference, arbitrage, and that's where they make money too as well. Okay, so these are sources of income that a bank maintains that term intermediation or has money to be able to create mortgages. Okay, kind of like a gas station. You got to pull over and fill up. So we're talking about Fannie Mae and Ginnie Mae. This is a secondary market. That's where the loans are bought off the primary. Again, Fannie Mae, Ginnie Mae, and Freddie Mac are the three you'll see on the licensing exam, okay? The one thing you want to know about Fannie Mae is under A2, they buy VA, FHA, and conventional, all three types of loans. Ginnie Mae is government owned, and they wholly are owned by the government, WHOLLY, and they provide secondary market financing, or they buy VA or government loans. And then Freddie Mac also government owned. I got to make a correction there. They're government owned too as well. They buy conventional loans only. Okay. So those are the three secondary warehousing agencies. All right. Which contract is not covered under the statutes of fraud? Which contract is not covered under the statutes of fraud? Which contracts are not covered under the statutes of? You remember statutes of frauds, we're talking about statutes. To be able to have an enforceable agreement or a contract, it's got to be in writing. So, but there is a contract that is not covered under that, okay, in this question. Let's go ahead and visit this real quick. So the statutes of fraud and enforceable contracts is what we're talking about. These are contracts conveying an interest in real property, must be in writing and signed, okay, to be enforceable in a court of law. Now, here are the enforceable contracts. These are the ones that are legally binding, okay, that the courts recognize. A purchase or sales agreement, an option contract, deeds and mortgage instruments, okay, and a lease agreement longer than 1 year, okay, a lease agreement longer than 1 year, okay, so a lease over a year. You get a lot of commercial properties, could be residential too. So under the statutes of fraud, in writing and signed, leases over longer than a year. Again, does it have to be? No, but to be enforceable in a court of law. Okay. And then obviously purchase, sales, option, deeds, and mortgages. Okay. So C, which is a 6-month lease. Why? Because it's less than a year. Okay. So to be enforceable in a court of law, over a year in writing. All right. The discount rate is best defined as what? The discount rate is best defined as what? Discount rate. What do you think? You got to define what discount rate is. We just talked about that. You remember we talked about the primary market borrowing from the federal district banks at a lower interest rate, and they turn around and sell at a higher interest rate called arbitrage. They make the difference on the spread. Well, the discount rate is what they buy it from the district bank at, right? From the Federal Reserve. So interest rates, obviously, see, I gave you the answer. Interest rates charged to banks for borrowing money from the Federal Reserve, okay? So again, watch this now. This is a very important concept you want to understand when it comes to financing or mortgage money. Okay, on homes. You ready? Federal regulatory bodies, in other words, the Federal Reserve System. That's Jerome Powell is our Federal Reservist. In other words, he is the chief of all when it comes to the banking industries in the United States. He's over all that. And it comprises, and it's broken down into 12 federal district banks, okay, as we saw on the map. Now, what does the Federal Reserve System do? They create monetary policy. This is where Regulation Z comes in, TILA, truth in lending, all those things that you've studied comes from a monetary policy with the Federal Reserve. And it does influence the availability and the cost of money. They have, watch this, they have the ability to tighten the water faucet or close the water, and we'll call that interest rates. They can raise it, which will squeeze money and not be able to. People can't afford to buy with higher interest rates, so the market will start to depress a little bit. Or they can lower mortgage interest rates, which opens a free flow of money where people can borrow because they can afford it, right? So they use that policy to help control with the open market policy and the monetary policy, creating restrictions and stuff. But to be able to control the interest rates, they can control the flow of the money in the economy when it comes to home purchases. Discount rates, this is the answer we're looking for. It's the federal district loan where they lend money at a discount. Now, don't get this confused with discount points, okay? Two different terms. Discount points is what a buyer pays interest in advance. Okay, remember 1 point is 1% of the loan amount when you calculate it. This is discount rate, what a bank borrows from the Federal Reserve at a discount and then turns around and lends it out. Okay. And then reserve requirements is nothing more than a mandatory depository that a bank must maintain. Okay. Here's the map, bigger. You can see Atlanta is District 6. Okay. And, everything, all the other districts fall in the bank. So Florida falls under Atlanta. So what they would do, the banks down in Florida that support federally related loans have the opportunity to borrow from the Federal Reserve through Atlanta, which is the district bank, at a discount rate. That's what that definition is. Okay.
For more practice questions, videos, and insight into the state exam, we encourage you to join our free exam prep webinar, How to Pass the Real Estate Exam Without Your Real Estate Book and with only 15 to 20 hours of study time. Click here to get registered.
All right. An appraiser has been asked to appraise a building lot in a quality subdivision. His research effort reveals that 5 lots have been sold in the past 4 months in the same neighborhood as the subject lot. Okay. So you've got 5 comparables the appraiser is going to look at. He's looking at 1 through 5, and I'm not going to go through all the measurements, but I'll just take the first line. A 100 by 130, and it's priced at $5,600. So we have to find out what the price per square foot is of that lot. Now, remember, in calculating, in real estate calculations, when you're doing a length times width, that's the area, and in the unit of measurements in square feet. So we take 100 by 130, and that would give us the size in square feet of the lot, right? We divide that into the price of it, we get price per square foot. So let's take a look at this. All right, so I rewrote the question, okay? And then what I did is, you can see in bold numbers is where I started my calculations. So this is one of these questions you got to pull. You're going to have to pull your scratch pad and your calculator aside and really slow down. And I'm going to use this word again. And you got to unpack this question very carefully. You miss one little tiny line, and you're going to get the wrong answer. Okay. So again, let's just do line 1, 100 by 130. When I multiply that out, I get 13,000. That's square feet. Divided into 5,600, it's 0.4307. Okay. Now, when I take, and that's per square foot now, and that's not per acre, so don't panic on that, right? God, that's cheap. No, it's per square foot, right? So the unit of measurements, and that kind of throws people off. Obviously, it's not per acre. So 0.4307, and then you're going to do that with all 5 lines. You're just going to do length times width, divide it into the price, and get a price per square foot. You're going to add them all up and take the average. Okay, so I'm going to add up all 5, divide by 5, and I get 0.4213. Then I'm going to take the subject property, because that's the lot being appraised. That's the subject property, is 110 by 130. Again, I get 14,300 times the average of the comps, and you can see that the lot's going to cost $6,023. Okay? It's a very easy concept. The really difficult part of this problem is you can see the detail and the errors that can be made. I mean, just one line and you mess up a calculation. So take your time on these, okay? When you unpack them, take your time, work them line by line, add them up. This may be one of these, it balances out. The questions balance out, right? You got 100 questions. You may go through a string of 10 that are very objective. You know the answers. And you may answer 10 questions in a matter of 4 minutes. And then you come across a problem like this. Don't take that same approach. Slow down, get your paper out. This may take you 3 to 4 minutes to work out. So it'll average out to where you're going to be able to answer all 100 questions in the allotted time. Some you'll go quickly, some you got to take your time, okay? And these are the ones you really want to take your time. So we're looking at answer D, 6,023. Okay. A buyer assumed an existing recorded $82,000 mortgage as part of a real estate purchase. This action will necessitate. So you got a buyer assumed an existing recorded mortgage of $82,000 as part of a real estate transaction, okay, or a purchase. So this action will necessitate what? What's going to happen? So when we talk about a buyer assuming a loan, the recorded $82,000, and you look at, because there's a couple of answers in there that make sense. Like answer D, the seller remaining primarily liable for the debt. Not the seller. The buyer is going to be primarily responsible. The seller will though be responsible too as well. But the buyer is primarily responsible. Okay, on an assumption they're both liable, but first the buyer and then the seller. Okay, and even though the buyer's assuming the loan, they still have to put a promissory note in there. Remember, I explained to y'all, if you sat in on my mortgage classes, when someone assumes a loan or puts a new loan in, the promissory note, listen to me, this is a very good concept to understand, is nothing more than a financial contract to the lender. Think of it as that. A promissory note is the document, is the evidence of the debt, is the obligation for the borrower, who's the mortgagor in this case, that has to pay that debt back and follow all the clauses and obligations in that. It is nothing more, make note of this, a financial contract. So whether someone is getting a new loan or assuming a loan, they're still going to have to put an agreement in place to pay it back. Okay? That ought to settle that issue. It's a financial contract. So whether you're assuming it or getting a new loan, you still have to have a new promissory note. You still have to have an agreement that you are going to pay that loan as assumed and follow all the covenants in that obligation and obligate that the borrower has to, or the person assuming has to obligate themselves to the clauses as well in that loan. So it's a financial contract. So what we're talking about is a new promissory note. That's what has to be done. The buyer has to sign that. The seller's not going to be primarily responsible, but the buyer will. Okay. So assuming a loan, buyer's going to take over. Remember, the mortgage requires the buyer to place a new promissory note. I always uncloud the issue because promissory note can be a little, not confusing, but gosh, promissory note. It's nothing more than a financial contract. Just like a purchase agreement is a purchase contract for a home. You got to have that obligation. Okay. A financial contract is an obligation to the lender. Got to have it, whether it's a new loan or you're assuming a loan from a borrower. Remember, under 3, the seller is liable if the borrower defaults. So the borrower is going to be the primary liable person in this assumption. Okay. Next question. Which statement regarding the recovery fund is false? Which statement regarding the recovery fund is false? What do you think? Looking for a false statement. And this comes obviously under the Florida Real Estate Commission and the Recovery Fund and what the rules apply and what the fund is. And we're just going to go ahead and review that. Okay. So when we talk about the Real Estate Recovery Fund, so who does it apply to? Okay. It applies to real estate brokerages. It's designed for claims involving real estate transactions. In order to recover from the recovery fund, you got to be dealing with an active licensee. So somebody that's doing a for sale by owner and someone buys their for sale by owner without any participation of a licensee, Florida licensee, they can't use the recovery fund. Okay. So it has to be a licensee that's active, involved in the situation. Okay. No punitive damages, only compensatory, only transaction money can be recovered. So, if they come to court going, I got to go to a therapist or, punitive damages, I'm staying up all night and, over this transaction, this rental lease, whatever the case may be, they're not going to award that. Okay. So punitive damages or personal damages are an award, only deals with the transaction. Got to have an active licensee. Cannot. Now watch this. The licensee is really responsible for paying out of his own or her own pocket the actual lawsuit. Okay. Only if the licensee cannot pay the judgment can they use the recovery fund. When they do, they are suspended until it's paid back. So keep that in mind. Watch the questions. First, it's the licensee's responsibility to pay the damages, compensatory damages, not punitive, compensatory damages. If they can't meet that, and that could be personal accounts and through E&O insurance, errors and omission insurance. If they can't meet that judgment, then they can go to the recovery fund. That amount that they take from the recovery fund to settle this judgment has got to be put back for that licensee to begin to practice again. And they are suspended until it's paid back. Okay. Now, the claim is 2 years from the discovery of the violation. 2 years. The maximum is 4. Okay. So that's a statutory time. The licensee acting in the capacity of a buyer or seller may also make a claim against the fund. And a claimant cannot be the spouse of the licensee. So no representation between spouses. Can the spouse claim from the recovery fund? It's $50,000 per transaction The maximum that can be awarded from the recovery fund is $150,000. That's how much they're going to pay out. So if FREC pays out a $50,000 transaction for 4 buyers, then it's going to be $12,500 each. Okay, if there's multiple parties involved. All right. So we're talking about answer C. So if we go back and look at the question, which is false. So a final judgment must be issued against the licensee, and the consumer must make an attempt to collect on the judgment. That's true. We talked about that. Got to be able to collect from the licensee if that's the case. Punitive damages and interest cannot be reimbursed, and that's true. An unlicensed spouse of the offending licensee is eligible. That's false. That's the one that's false. Okay. Licensees must hold an active license at the time of the alleged act, and that's true too as well. Okay. All right. Which variable influences supply? Okay. This is an economic question out of the economic model of supply and demand. Which variable influences supply? Okay. So we're talking about influencing supply, and then you got influencing demand. So let's look at this. This comes out of the content of supply and demand. This is the principle of supply and demand. When we talk about supply or the availability of real estate, okay, so what variables do affect supply or the amount of real estate that's developed, okay, is skilled labor, new construction, the availability of loans, construction loans and financing, the supply and demand of land availability, right? Got to have land. And obviously raw materials, okay? The demand part of it is the ability to purchase, right? So the pricing, how the pricing is adjusted through economics, right? How the economy is doing. Population of the household composition, income of the consumers, what kind of, and that all falls into an economy. Local economy, obviously with jobs and income level, the availability of mortgage credit, right? Or mortgage money. We talked about that earlier, right? And then social preference or taste, right? Is the demand features, okay? So review a little bit of supply and demand. This question is asking about supply, and the ones that fit this is the availability of labor, okay? Price of the real estate, income, and all fall under demand. So availability of labor is going to be supply. All right. Under which circumstance may a real estate licensee lawfully refuse to show a listed property to a member of a protected class who has specifically requested to see the property? Under which circumstance may a real estate licensee lawfully refuse to show a listed property to a member of a protected class who has specifically requested to see it. So we're talking about fair housing here, right? Very critical, very important topic here. What do you think the answer is? Is there ever a time when you can refuse to show a property to someone of a protected class? National origin, right? Race, color, religion, familial status, handicap, any of the protected under the Fair Housing Act of 1968. Is there ever a time when you knowingly, you got the property listed, knowingly they're a protected class, national origin, color, race, doesn't matter. You knowingly they're in a protected class. Can you ever refuse to show property? This is what this question is asking. Now, let's talk about broker relation. Okay, this is in your content under the Florida rules, right? The statutes of how you form a relationship with your client. We're going to specifically talk about a single agent relationship in this. Remember, it's disclosed in writing, and you use the single agent form, right? Doesn't have to be signed, but you have to disclose it in writing. And basically, this forms a relationship, and let's use the seller here. This forms a relationship with a property that you're going to list for the seller, and you have to represent a fiduciary with this seller. It's a single agent form, so you're representing only the seller in this case. This is the example in the question we're seeing. Remember, you're listing someone from a protected class wants to look at the property, and should you or can you deny that request and still not be in violation? All right, so you've got this relationship form. Now watch this. Under these duties, you have a confidentiality. Now look at number 3. It's called obedience. You have to obey all legal requests. Okay, that is your fiduciary responsibility to your client under that single agency agreement. You have to obey them. So watch this. Let's circle back to the question. Is there a time, and I'm going to shorten it up, is there a time you can refuse to show, and let's put it in to a member of a protected class, say someone from a different national origin that you know about? Can you refuse to show it? And the answer is yes, you can. Remember, fiduciary under the single agent, you have to obey your client. Your client says under answer C, I'm going out of town. I'm instructing you not to show the property until I get back. Basically, when I'm out of town, I don't want anybody in my house. He's not saying you can't show the house to certain national origins or restricted from showing it to certain people of religion. He's not telling you to do that. If that was the case, yes, never. But in this case, the seller is telling you, I'm leaving town, and for no other reason, you are not to show this property until I get back. You can then deny any request that comes in, regardless if they're in a protected class or not. So we're talking about owners out of town instructed the listing agent not to show it. All right. An increase in the mortgage money supply is called what? Oh, we saw this in the beginning of the slides. Y'all ought to get this right away. Increase in mortgage money. We saw this in the very beginning. We filled up on gas. Increase. Got a full tank. Okay? All right. Let's look at this. All right. So the primary sources, again, and I'm bringing a different slide into this. When we talk about the term intermediation, we're talking about the flow of funds into the bank's depository. Disintermediation is a lack. Remember, the primary market, there's only 2 markets we have in the mortgage industry, in the lending industry. You got the primary market, and you look at the bank circle. That's where the primary market is. Those are banks and savings association, along with some other people, institutions that lend money. Okay, that's where it's done, primary market. Then they take these loans, and as part of one of their sources of income to maintain, to get intermediation, which is a full, have a flow of money. To get that, they sell it to the secondary market, which is Fannie Mae, Ginnie Mae, Freddie Mac, or they borrow from the Federal Reserve, or they take deposits from people that open accounts. Okay, 3 different types of ways they get money. Okay, So disintermediation, lack of funds, intermediation, a flow of funds. Okay. So we're talking about A, intermediation.
Ready to pass the Florida Sales Associate, Broker, Mutual Recognition, or Endorsement State Exam on your first try? Get our exam prep database that contains practice exams tied to over 1,000 exam-style questions with detailed explanations. Enjoy 3 months of 24/7 access from any device, including desktop, laptop, tablet, and mobile. Click here and use the coupon code YouTube to get a special discount.
All right. The ownership rights that permits an owner of real property to sell, mortgage, dedicate, or otherwise dispose of all or any portion of the property is referred to as what right? Now we're talking about general principles and practices here. This is ownership. What is it called when somebody has the right to basically alienate or transfer the property? Dedicate means donate. In other words, dispose of it. What do you think it is? What are they called? Okay, good. Got a couple answers there. And all of these, disposition, possession, control, exclusion, those come under the bundle of rights. And we're going to see that right now. So watch this. Take a snapshot of this. For basic property rights, when it comes to the bundle of rights or rights of ownership, deep C, just like it's spelled. Disposition, enjoyment, exclusion, possession, and control. Deep C. Okay? Now, each one has a definition. So we look at the one we're looking at is disposition. That is the right to sell it. In other words, you can transfer that property in any way. You can refinance it. You can donate it or dedicate it. You can sell it. You can lease it. You've got control of that property to do whatever you want to it in an alienation or transfer way. Okay? Enjoyment, right to enjoy, again, without trespassing. Exclusion, you don't have to let others on. Possession, obviously the right to purchase and control to use the property as within the law, okay, within the legal limits of the law, okay, which is control. Deep C, good memory aid. All right, an office building produces an effective gross income of $96,400, building operating expenses totaling $36,600, and the monthly mortgage payment is $2,240. What is the building's net operating income? Okay. All right. So an office building produces, again, an effective gross income of $96,400. The building has an operating of $36,300. Monthly mortgage payment of $2,000. They want to know only what the net operating income is. All right. So watch this. Here's another memory aid. Right? It says, please visit every other night dressed casually. Okay? Please visit every other night dressed casually. All right? So please visit every other night dressed casually. Potential gross income minus vacancy rate gives you effective gross income. That's every other night, or excuse me, other is operating expenses. Net is night. Now, the debt service and the cash throw off or the pre-tax, those are for broker questions. So really, you only have to go as far as please visit every other night. You don't really need to dress casually for your salesperson. Okay? Now, when is this used? More than 4 units. There's a cap rate or a rate of return, an investor's determined for a return, and it converts. You have to convert everything to annual figures. Okay? You got to convert everything to annual figures. So look in the blue box to the bottom right. There's the question again. I'll put it back in here. So here, look, watch this. This is what I do. Please visit every other night. And I draw this out. This is a math problem. Pay attention. This is very important. I put my P just like I got it right there. And I put my V under it with a subtraction sign, and I put a line under it. Then I put my E, and I put my subtraction sign. I put my O and a line under it, and I put my N. Now, you can put debt service and you can put cash show off below it, but you're not going to be able to use, you won't need to use them. So watch this. So what's my P? Well, I don't have a potential gross income, so it's 0. I don't have one. What's my vacancy in the problem? I don't have a vacancy, so it's 0. So 0 minus 0 gives me my effective gross rate of what the problem gives me. They give you the effective gross income already. That's why you don't have a PGI and a vacancy rate. They already give you the effective gross income. You start at 96,400, as you can see in my slide. Take a picture of this. And then operating expenses, they give it, everything's annualized. They already give you all the annual numbers. So 36,600. So I subtract that. My net operating income is 59,800. That's all they want to know. They don't want to know anything else. Now, it's interesting. They put a mortgage payment in there of $2,240. That's your debt service. If you multiply it by 12, the total debt service that they're paying for that property is $26,880. If I subtract that from net operating income, I get my pre-tax is $39,920. Okay. Now, they throw that in there to throw you off. You're like, gosh, you got a mortgage payment in here. You know, now I'm not going to know what to do. But listen to me. This is very important that you grab this concept. Pay attention to this. If you stick with please visit every other night, and if you want to put dress casual, you can, but please visit every other night, and you lay it out like I got it here, potential gross income minus V, put a line under it, gives me E, minus my operating expense, put a line on it, gives me my net operating income, and then come to the right of that and plug your numbers in and just go down, subtract all the way down until you get your numbers. You can see that the debt service, even though you can put it in there like I did here, it doesn't mean anything to the problem because your answer is net operating income. So you can see you don't need the mortgage. Okay? All right. A subdivision plat map. A subdivision plat map. Now, we discussed this when we went into legal descriptions. Remember legal descriptions? We talked about meets and bounds, government rectangle, and we talked about lot and block. Lot and block is usually a legal description that is based on a subdivision plat map. Okay? Developers have to put together a subdivision plat map, right, to get pre-approval to develop subdivisions. Okay? So, well, you just have to know what a subdivision plat map is. So let's take a look at this. Remember the lot and block survey, like we did. We saw that legal description, also called the recorded plat method. And basically, the plat subdivision is divided into lots and blocks, and it's going to give you all the information on there. Now, if you want to take a picture of this, I kind of drummed up a nice little photo for y'all. And again, the plat map is answer D, indicates the size, location, individual lots, streets, utilities. So this is a section. Obviously, you can see the street called West F Street, right? It's a cul-de-sac. And you can see up to the top, the lots, and you can see block A and lots 1, 2, 3, 4. I got utilities over 3. 4, you come down 5, and you come back to the left, 6, 7, 8, and there's block B. Okay. And you can see the utilities are laid out on it, right? Streets are laid out on it. The surveys of the lots are laid out on it. So this is a subdivision on a map. And this is what typically a developer has to get approved by the council, by the zoning board, before they can start building. Okay. And they have to put all this stuff in. These streets have to be put in. Remember, concurrency is or concurrent is a term used that all the prerequisites, the infrastructure has to be put in before they can start building houses. Okay. Now, if you look under subdivision plat map, this is a typical legal description of what you'll deal with when you start filling out contracts, and you'll see deeds that are made. And when you reference a legal description, it may be recorded. Yes. Lot 1, you can see lot 1 right up there at the top where block A is. Block A, so I got lot 1, block A, Glendale Estates. If you look down at the bottom, right where I got subdivisions, it says Glendale Estates. So the legal description that goes onto a contract will define that lot that's a corner lot off the main drag and that cul-de-sac. Okay? Lot 1, block A, Glendale Estates. That identifies that property right there. So that's what you'll be dealing with primarily when you're dealing with subdivision, that type of legal description. And you can see that relative to how the map's made out. Okay? So it indicates the size, location of individual streets, lots, utility lines, all that stuff. Let's see. Ethan says, why would the monthly mortgage payment not be included in the operating expenses? Yeah, good question there, Ethan. anytime an appraiser appraises property, they're using the method of income approach to get the value of the property itself. And it's based off the income earned, which is a net, vacancy and operating expenses taken out of what is made on it to get a net operating income. The reason the debt service is not used is because mortgages come in various packages. In this particular mortgage, this isn't going to define, it won't define what a building is worth, right? It's just a payback method, all right? Now, it's used for pre-tax, right? So when the investor is going to start paying, have to pay the tax on the building and stuff, they have to use, and they can take out and get credit for the mortgage and the debt service. So that's a pre-tax number, okay? But to determine the value of a building, the appraisers only use what income. The approach only uses the vacancy, operating expenses, and what net operating income it produces, along with the capitalization rate, okay? So the debt service, the mortgage has nothing to do with that when it comes to appraisals, okay? All right. Any contract that obligates both parties to perform in accordance with the terms of the contract. Any contract that obligates both parties to perform in accordance with the terms of the contract. And the key word, and I see everybody kind of hopefully using this method, when you, again, going back, always use that approach, unpack this, look for key words. We're talking about a contract. We're talking about an obligation. So it's an obligatory contract, both parties. So you got buyer and seller, for example, you could say. They both have obligations. So what are we doing here? It's bilateral, right? Good. And again, just to review real quick, classifications, you've got bilateral and unilateral. So bilateral, both parties in agreement to obligate to do something or perform, right? So in a purchase agreement is the example for that. So watch this. On the test, they may ask you, which of the following is an example of a bilateral agreement? Look for a purchase agreement or an agreement that has obligations from both parties, okay? A unilateral is only one party that obligates to perform. This is an option contract. So an option contract, always remember this, it's the option to buy. So the actual buyer is called a optionee. Okay, the optionor is the one that's going to grant the or transfer. You remember in a regular home purchase when the grantor transfers the deed to the grantee. Well, the optionee is the one that's going to receive the deed if they decide to buy it, and the grantor is going to be transferring. So the optionor is the owner, the optionee is the buyer. But watch this. It's unilateral because the optionee, the buyer, doesn't have to buy the home, can walk away from it at the end of the agreed exercise date. But if the optionee decides to buy it, the optionor must sell it. So there's the one way or unilateral obligation. They must sell it. Here's another one you might see on an example, on a test, on the licensing exam. If a broker is in a first meeting of the year with his agents, okay, or with the agents that work for that broker, and the broker makes an agreement with the agents and says, look, the first agent that brings 10 transactions is going to get a $5,000 bonus. That would be another example of a unilateral commitment. Why? Because the broker has to pay the $5,000, but the agents don't have to bring 10 agreements or 10 transactions, closed transactions. Only if one does, that has to be paid out. Okay? So distinguish between bilateral and unilateral. All right, so we finished up with classifications of contracts. All right, here we go. Next question we're going to talk about. A property owner defaulted on the mortgage prior to foreclosure. The owner paid the lender the missed mortgage payment, plus the expenses incurred by the lender as a result of the default, which mortgage provision allows the borrower to make mortgage payments as specified in the promissory note? Okay. You remember we talked about the promissory note as being what? A financial contract. So you see there's an acceleration clause, right to reinstate, promise to repay, a defeasance clause. So you got a bunch of different clauses inside this promissory note / financial contract that the mortgagor signs. Okay. And so what we're talking about here and what you want to understand here is it's prior to foreclosure, the owner missed payments, but then they're paying them back. Okay. In other words, they're catching back up. So what do you think that answer would be? It allows, remember, this is an obligation in the contract. It allows the mortgage or the one that borrowed the money, allows them to reinstate. I just gave you the answer. Anyway, reinstate their position as long as they make it up. Okay. So let's kind of review here about the essential elements of a mortgage and tie this into the question. So what are we talking about? Some of these clauses in this financial contract we're talking about. So prepayment clauses, that's where a person cannot pay it off early or they're going to get penalized for it, usually a percentage, not allowed on government loans. Acceleration clause, if they don't make the payment, this is where the lender can call the entire note due on the loan amount that they owe. And you say, well, John, how in the world can they pay it off if they can't make a monthly payment? Well, the acceleration clause is hitched and tied into another term called foreclosure proceedings. Okay. So this allows the lender to proceed with foreclosure. And then the right to reinstate. This is based on the equity of redemption, okay, which means after foreclosure, but before the auction sale, the borrower or the mortgagor can reinstate and catch up. If they pay all the, the incurred fees from the lender, from the foreclosure and the process of doing this and the interest and the penalties and all that, if that's all caught up, that is a right to reinstate. And then you got a due on sale clause, means if the property does sell, if that property is sold, then the loan's got to be paid off. Okay. So if you sell the property, you got to pay the loan off. And then a defeasance clause is the lender sends a release. It's a letter with a mortgage. It's called the satisfaction of mortgage. It's a release indicating the loan has been paid. So that's how property is transferred. When the bank says, yes, it's been paid, they'll get it. It's called a defeasance clause, but they send a satisfaction a letter of satisfaction, meaning the loan's been paid in full. All right. A licensed real estate sales associate and broker desire to open a new real estate brokerage firm as general partners. Okay. Which statement applies to this situation? So this falls under the section of what we call business entities. Okay. This is business entities. So in other words, general partnership, limited partnership, LLC, limited liability, limited liability partnership, all these things that we call business entities. So this is what this category falls. But you have to take it a step further. Not only is it a business entity, but we're dealing strictly with real estate. Okay, so you got a licensed real estate sales associate and a broker. They want to go into a partnership together and open up as general partners. So what do you think that is? As general partners. All right. So when we talk about general partnership, and again, it falls under the category of business entities. Remember, you got to have at least two general partners. Okay. Now let's take this from outside of real estate brokerage. Okay. Got to have at least two general partners. All right, they're taxed individually, and they are going to be responsible for the debt and the liability of the operation. Okay, got to register with DBPR. Okay, under the partnership name. Now, when it comes to a real estate partnership, one general partner must be an active broker. All general partners serving the public in a real estate activity must be active brokers. under the general partner. They're serving the public in that capacity for commission money. Okay. Now, all general partners not engaged in public real estate activity, like inactive or unlicensed, or just a, like a CPA or somebody that's, not performing real estate activity or real estate duties, they must register with DBPR, but can be a general partner. And then basically what we're talking about, active sales associates and broker associates cannot be general partners, but employees. Okay. Now there is a, what they call a 14-day replacement rule. If a broker is suspended or if a broker dies, so there's a 14-day allotted time to replace that broker. Okay. For that general partner as that general partner. Okay. So we're talking about answer D, sales associates may not be a general partner in a real estate brokerage.
For more practice questions, videos, and insight into the state exam, we encourage you to join our free exam prep webinar, How to Pass the Real Estate Exam Without Your Real Estate Book and with only 15 to 20 hours of study time. Click here to get registered.
Okay, Freddie Mac is a what? Freddie Mac is a, what do you think? We went over this earlier, so this ought to be, this is one of these questions where this ought to take you about 10 seconds, right? So we identified the 3 types of secondary markets, right? So it's a secondary market, okay? Again, in review, this is where loans, again, now when the secondary market does buy loans, they do sell them as mortgage-backed securities to Wall Street. So that's how that money flows back in to the secondary market for them to buy more money or more loans from the primary market. Mortgage-backed securities are just like buying stocks or regular securities, corporate securities, but they're in the form of mortgage bundles, right? And they got ticker symbols and they earn, I guess, I've never really made an investment there. I'm a big tech guy, so I like tech stocks. So secondary market, Fannie Mae, Ginnie Mae, and Freddie Mac. So it's a secondary market. All right, a special flood hazard area is what? A special flood hazard area. What are we talking about when we say special flood hazard area? Let me give you a little bit of a hint. When you, in some areas may be different, but mostly we call it flood zone A, right? That's where it's prone, special flood hazard, it's prone to flooding, right? Okay, so let's look at this. And I'm going to talk about, just for a few seconds, about flood zones. So it falls under the National Flood Insurance Program, or the NFIP, okay? And they define a special flood hazard area as a 100-year floodplain. Chance of flooding is 1%, okay, each year, all right, in 100% per year, okay? So that's a pretty high average, okay, even though 1% in 100 doesn't sound much, but it is. It's flooding, okay? And when we're talking about flooding, we're not talking about a little bit of runoff. We're talking about flooding, right? So that brings things into perspective, okay? It's identified as flood zone A, subject to flooding, okay? Lenders require flood insurance, okay? This is where flood insurance is going to be bought, okay? Now, flood insurance is available, and you want to know a couple of these points right here because there's other questions associated with these flood type questions. There's other questions out there. Flood insurance is available, but not mandatory for property located in low risk and moderate risk areas, okay? So only in a special flood hazard area. So flood zone A, but you got B, C, or X, right? B, typically the lender may or may not require it, depending on it. C, it's not required, and X is the same as C. So depending on what zone that you fall into as far as property goes, whether it's mandatory, optional, or not, depends on what category it falls in under the actual flood in the flood zone. And then the The licensee should advise the buyer to research the cost of the flood insurance. They got a question out there that goes, does a buyer save money if he waits till closing to purchase insurance? The answer is no. The buyer's going to have an insurance binder already put together for the lender for them to even close the transaction. So there is no saving money, to wait all the way to the act of sale. Okay. I've seen that question out there too associated. All right. Next question is, what information is the best indicator of a loan applicant's willingness to repay a debt? Willingness to repay a debt. Talking about the information that is best indicator. What do you think it is? Willingness to repay a debt. Credit score is, what it reminds me of? Credit score is like an abstract for a title search, right? There's a lot of documents involved in an abstract, but it gives the big picture of the whole picture about that house. Okay. When it comes to a credit score, that is the big picture, right? If you just get a W-2 income statement from somebody, let's say they do make $300,000 a year, is that going to tell you anything about them being on time paying their debt? The answer is no. Okay. Housing expense ratio, the actual payment of debt, no. All it's going to do, housing expense and total obligation ratio, is just going to give you a percentage they can't exceed. That's a pre-qualification number. That has nothing to do with the ability or any indication that says they will repay the debt. But what will show it is a credit score, because what's involved in a credit score? Not only do you get a number, which gives you the big picture, the lender, the big picture, 750 all the way down. People have them as low as 400, and it gives them a big picture. But what is that number in relationship to? Well, the amount of debt someone has, obviously, not relative to the income that they make, has nothing to do with it, and also the repayment, because it does show on a credit score, it will break it down. If they have defaulted on any type of unsecured or secured debt, it'll show collections and all that stuff. So it's a nice snapshot, a credit score. And if you got investment properties, this is one of the tenant selection criteria that you can use, as you can run a credit report on these folks that are going to lease your property. And it's a good indication, are they going to repay it or are they not? Okay, because it's got a lot of good information on it. And if you get an opportunity, go and get a credit report and print one out. It may cost you a little bit of money, but it gives you an opportunity to see your breakdown. And it goes back a lot. It goes back pretty good ways, right? And it'll show. If you miss payments, they'll put it on there. All right, so that's what we just basically been talking about. So the credit history, credit report shows the credit score, consistency on time payments, the current and previous debt. It's a willingness to pay, okay? And we talked about qualifying ratios, TORs, HERs, housing. All that's going to do is give a determination of a ratio. Do they pre-qualify? And basically, when it comes to a qualifying ratio, that's the primary market. They use these percentages. You see these conventional where it says TOR 36%. In other words, total obligation ratio on a conventional loan, that's what they use, a TOR only. They don't use a housing expense only. So they use total obligation, which is income with all their expenses. Okay. Now, 36%, if they exceed that, there's no qualification. But that 36% isn't made up by the primary lender. That 36% is a secondary warehousing. That's the secondary market's standards. Because guess what? If a lender sells a property or lends money out and their TOR on a conventional loan is above 36%, it won't be eligible. The secondary market won't take it. So a lot of times the primary market will pre-qualify borrowers based on the standards of Fannie Mae, Ginnie Mae, and Freddie Mac, because they know they're going to need to sell that at one time. If they need to, they want to make sure they got everything in place to be able to sell it. Okay. And that makes sense. That makes total sense. Got to have money. Intermediation, we're full. Disintermediation, I need to sell some loans. So I turn around, sell loans to the secondary market. If it doesn't meet their criteria, they won't buy them. And this is one of their criterias. Okay, a properly executed contract that has its purpose and a legal objective is what? A properly executed contract that has as its purpose an illegal objective. It's illegal. So let's go over real quick. We're going to summarize and visit the essential elements of a contract. Okay, the essential elements of a contract. Remember, a contract that's valid meets contract law when it has contractual capacity of all parties. Everybody's of legal age and sound mind. We all have offer and acceptance, meeting of the minds, which is evidenced through signatures. Got to have a legal description. We saw in our lot and block map, the legal description that we kind of have and we see as an example that what's standardized usually in the subdivisions outside of urban, suburban, you get in rural areas, you may go into a meets and bounds description, but most of them are lot and block, okay? Got to have a legal description, surveyed legal description. Legality of object. Got to have purposes, has to be legal, okay? And then consideration, either valuable or good consideration, okay? So you want to know this. If you want to take a little picture of this, you can. You got to know the essential elements. This is what makes a contract valid. This is the enforceability of a contract, okay? That meets contract law. Now, void, voidable, and unenforceable. Void, no contract. Missing an essential element. There is no contract. Don't have a price, don't have a legal description, don't have a signature, etc. Voidable, there has been fraud or innocent misrepresent, either innocent or purposely misrepresent in the agreement itself, and there's been an injured party. So the party that's been injured can disavow their position of obligation and get out of the contract without being in jeopardy or violation of a default. In other words, the other party lied to them about the square footage, lied to them about a maybe a disclosure on a something wrong with the house, or whatever it was that someone has been injured by. They can disavow themselves. That is voidable. Okay. Unenforceable, illegal to do the contract. Okay. Not enforced by a court of law. From anything that deals with, cohesion or anything that makes it unenforceable to the point where it's not a legal contract. When it comes to real estate, exceeding the statutory time limit is unenforceable. It's not a legal contract. Okay. So unenforceable is what we're looking at here. Okay. Which statement is true regarding a private mortgage insurance, or PMI? Private mortgage insurance. Now, again, do you remember we talked about unpacking the questions? First thing that comes to my mind right now, when I read this question, I go, how many types of mortgage insurance do we have? And two come to my mind. Mortgage insurance premium, MIP, that deals with the government. MIP is government. PMI, private, hence the word private, is conventional. So we know we're dealing with conventional loans when we're talking about PMI. Okay? That's for one thing. So I know C can't be an answer because the federal government is not the insurer on the PMI. That would be an FHA loan. That would be MIP. So I know I'm dealing with conventional loans. So C's not the answer. PMI is charged to a non-veteran. Again, it's a non-government loan. It's a private loan. So C and D doesn't fit this at all. So I can eliminate that. B, FHA, obviously is another government loan. B, C, and D all fit the MIP. And this is the importance. Listen to me. This is what makes this so clear in the vision you can create when you read these questions and unpack them. Key words and understanding. When you see the word PMI, you know right away, no government loans, none at all. Do I have to worry about that? So knowing that, you can just go down and eliminate B, C, and D. You know A has to fit this definition, but you got to simplify it. You got to try to make it to where you see the vision of it, right? And understand the difference between PMI. You understand PMI is conventional, MIP is government. So nothing that has a government answer in this question would fit it. Okay. Doesn't matter what the 90%, 80%, it doesn't matter what that says. We know that A is conventional. That's private. The rest of them are government. All right. And again, this is the explanation we're talking about. MIP down here, mortgage insurance premium. That's for government loans, FHA. Remember, VA don't even have insurance. They're guaranteed, right? So there's no insurance. Okay. On July 1, a broker received conflicting demands from a buyer and seller regarding a good faith deposit. 12 business days later, the broker is unable to resolve the conflict between the parties and notify FREC. How many days does this broker have remaining to implement a settlement procedure? Okay. July 1, a broker received conflicting demands from a buyer and seller regarding a good faith deposit. So right off the bat, we know we're dealing with a broker right off the bat. Again, before I look at answers, I read the question. I kind of a little bit of a 5, 10 second, 15-second discussion. This is how I unpack these questions. I do it line by line. Broker, conflicting demand. Okay, buyer and seller agreement over deposit. So the broker gets conflicting demand. So what's going on here? Well, the buyer and seller can't agree who gets the deposit. So the broker now is in a position where he has to determine what to do, or she. Okay. And then 12 business days later, still the broker can't resolve the conflict. Now, the broker has to know the law, right, that FREC has in place about reporting and executing the dispute settlement procedures. Okay. And that's what we're going to go over now. So here's how this works. Remember, under 475, conflicting demands, the buyer and seller make demands regarding how the money is going to be dispersed. Could be a $5,000 deposit put in by the buyer, but the seller says, no, you ain't getting all that back. And the buyer says, oh, yeah, that's my deposit. And so there's a conflict resolution that needs to be resolved. Okay. Now, the law says 15 business days, the broker must notify FREC within that time. You notice the question read, he took 12 days to try to resolve it himself. So he's still within the law because he's got 3 days to report it after that. But now what they're going to ask is, how many days left does he have to actually implement? And that's a 30-day business day under 1B, 30 business days to execute. Well, if he took 12 to try to figure it out and then reported it on the 12th day, he's actually got, out of 30, remember they run concurrent, out of 30 days, he's only got 18 left to implement the procedure. And you can see off to the right of 1A and B, I did a little timeline, 30 minus 12. Remember, 12 days to notify is 18 days. So you look on that bottom line, there's a whole line that starts at 0, 15, and 30, right? 15 days to notify and 30 days to implement. And so on the 12th day is when he notified. So if I take 30 minus 12, that means 18 days left, they have to implement the procedure, okay? Now, for settlement procedures, if you want to take a picture of this, this is called MAIL. This is another good memory aid, MALE. And hold on one second. Okay, so MALE, so mediation, arbitration, litigation, and EDO, escrow disbursement order. Okay. Mediation and arbitration, a lot of people don't understand the difference between those two. But here's the basic difference between mediation and arbitration. A mediator is a conflict resolver. Let's say, for example, you and I have a dispute over the $5,000 deposit. If we go that route and get a mediator, which will cost money, okay, from both of us, if we get a mediator to come in and mediate for us, we can agree or not agree even after that's over with. But if we do agree for a mediator, that mediator has resolved the conflict with us agreeing with their resolution. Okay? So we're both happy and content with that. It's a fair decision. If it got to arbitration and one of us said no, or maybe next step would be to arbitrate before going to court. Right? Again, these are all quasi-type judicial remedies outside the court system. But when we bring an arbitrator in, they're going to make a decision. So we don't no longer get to conflict resolve and be happy. Somebody's going to walk away not happy if it's the wrong answer. So mediation is a conflict resolution where both parties agree, they're both satisfied. Arbitration is actually a quasi-judicial type judgment made from an arbitrator, like acting like a judge. And then, of course, the next step would be litigation, taking it to court. Declaratory judgment is where the broker does have an interest, maybe needs to have some costs pulled out of this deposit in the agreement for whatever it may be, or interpleader deposit. There is no financial interest in the deposit. They just turn it over to the court. And then an EDO is where the broker will submit it to the Florida Real Estate Commission, and they will execute a decision. Okay. Now, between the time it's sent off to FREC for an EDO and the parties do decide and they come to a resolution, a conflict resolution, under D, first bullet point there, inform FREC within 10 business days if settled or if they decide they want to go to court. Okay. Before an EDO is issued. All right. So conflict resolution or conflict demands. All right. 15 business days to report, 30 business days to execute one of the 4 settlement procedures: MALE, mail, mediation, arbitration, litigation, and escrow disbursement order. Okay. All right.
Ready to pass the Florida Sales Associate, Broker, Mutual Recognition, or Endorsement State exam on your first try? Get our exam prep database that contains practice exams tied to over 1,000 exam-style questions with detailed explanations. Enjoy 3 months of 24/7 access from any device, including desktop, laptop, tablet, and mobile. Click here and use the coupon code YouTube to get a special discount.
All right. Which written instrument authorizes a person to act for and on behalf of another person? Which written instrument authorizes a person to act for and on behalf of another person? Okay. All right, let's look at this. If you come down and you look at number 1, power of attorney, this is the authority to act for another in a specified or any type of legal matter. In other words, you've got the authorization to do it. Now, that gives you the authority. That is the document that a person signs. It gives them the authority to act for another in specified or all legal matters, okay? What they're called is an attorney in fact. So be careful reading the question. And so if you circle back and look at the question, they're saying a written instrument. So they're talking about the document. That's called the power of attorney. But the individual is called an attorney in fact, okay? So be careful about reading the question. Are you identifying an instrument or are you identifying a person that has that authority? That would be an attorney in fact, okay? So don't confuse those. They got both those answers up there, okay? A couple other ones you want to know about under ethical practices. Everybody understands commingling. Conversion. Everybody understands you can't use escrow money for personal expenses. Brokers can. Culpable negligence. Again, a broker failing to perform outside their brokerage duties, okay? Whether a single agency duty or not, under common law, under customary practices, culpable negligent person can be sued even if it's not in violation. So there's nothing like transaction broker, no brokerage relationship, anything like that that would put you in a non-fiduciary role to a principal, or excuse me, to a customer, does not negate the fact that you can't still be culpable negligent in a transaction, okay? So we're talking about performing the duties, okay, that's associated with that agreement. Fraud, that's intentional. Deceit, got to have damages. So somebody knowingly, other than misrepresentation, they're called innocent misrepresentation. In other words, it was an accident. Fraud is someone that knows it's wrong, but it still does it, okay? And in the code of ethics, guess what, you guys? Guess we have to do it biannual. Every 2 years, you got to take a code of ethics course. You got to take it every 2 years, okay? All right. And then disclosure. Okay, property defects, again, agent's interest in the property, client funds, identifying advertising, compensating parties. These are all under ethical practice, but the one we're talking about is power of attorney. Okay. All right. A buyer signs a contract to purchase a seller's home for $370,000. The listing broker submits the contract to the seller, but the seller insists on the listed price of the $380,000. The broker prepares a new contract for $380,000, but the buyer refuses to sign. The seller then instructs the broker to take the buyer's original offer back, $370,000, because the seller has decided to accept it. The buyer has changed his mind and refuses to accept the contract. What is the result of this? See, this is one of these, it's not a math problem. Sure does look like one though, doesn't it? But you want to treat this like a math problem. This is where the technique about unpacking. So let me show you. I'm going to give you an example. This is an example I'm trying to teach y'all on testmanship, testing strategy, how to answer these type of questions. Watch this. Again, we're going to go over the concept of what we're talking about, but for the question itself, you want to pull your scratch paper out, even though you're not going to calculate anything, because you're going to need to break this, and I call the term unpack it, okay? So again, reviewing the essential elements of the contract, CULC, contract capacity, offer and acceptance. This is the premise of what this question is about. Is this buyer in a legal situation, in a legal agreement where it is enforceable on him? And we're going to look at that, okay? Watch. First step I'm going to do is I'm going to break this. I'm going to unpack this problem just like it says. So the listing price is $380,000. The buyer signs a contract for $370,000. Okay. So I got a list price, got the listing broker, got a buyer puts in an offer for $370,000, $10,000 below list price, not unreasonable. But the listing broker submits it to the seller, just like you're supposed to, right? Immediately submitting all offers. Step 3. The seller basically told the listing broker, no, we want $380,000. So the broker prepares a new contract. What's that called? A counteroffer, right? So the counteroffer is for $380,000. They put the offer in for $370,000. They're going to basically counteroffer, which is considered under law a new offer. They're going to put a counteroffer in for $380,000. The buyer rejects it, checks the box, signs it, rejected. Sends it back to the listing agent. Listing agent, again, immediately gives the rejected offer back to the seller. The seller instructs the broker to now give them the original price at $370,000 on their original offer. The buyer changed their mind. So what's the situation? There is no valid contract at all. Why? The buyer put the offer in first. The seller counteroffered, the buyer rejected, and now the seller wanted to go back and have him accept the original offer. They changed their mind. Are they obligated to a contract? Absolutely not. Nothing in writing, no signature. The absolute principles of contract law under CULC are not involved in this last offer, okay? Everything, the first one's been countered, then it was rejected. And then now it seems like what the seller instructed the broker to do is go back and offer him at $370,000. And it was kind of like maybe it could have been a verbal or say, hey, look, I'm going to send you an offer back for $370,000. And they said, no, we changed our mind. So they're not obligated. There is no contract. Okay. You see how you break this down? So you got your test question, and then over on your scratch paper, you go through it, build a scenario out, because you can get lost in this. You can absolutely get lost in a question like this, okay? All right, which legal instrument would contain the interest rate, loan amount, maturity date, and payment schedule? Which legal instrument would contain the interest rate, loan amount, maturity date, and payment schedule? What are we talking about here? Yeah, we're talking about a legal instrument, all right? And we're talking about interest rate, loan amount, maturity. We're talking about a loan, right? So what's that instrument called? It's called a promissory note, right? So we know it's not a lease or a deed or a closing statement, right? So it's the instrument that shows the financial obligation called the promissory note, or the note in short, okay? So again, the promissory note is the written instrument that shows the evidence of debt. Now listen, very important. I always use and relate this concept when it comes to promissory note. I look at it as what? A financial contract. There's an obligation from both parties, the mortgagor and the mortgagee, but nevertheless, they term it a promissory note, but it's really a financial obligation. It's a contract, okay? Because it shows the evidence to repay. It's got to be in writing to be enforceable. Negotiable instrument, obviously, can be sold. Also secondary markets, but also they can sell to another primary lender too as well. And it contains the amount, interest rate. So it's got all the metrics of the loan on this promissory note, okay? It's usually recorded in land records, not required. And again, it shows if it's a secured note, in other words, lien theory, which Florida is, there's a mortgage, okay, which is a lien that they take. They extract the information from the promissory note and they create a mortgage, a document they file in land records. That's a mortgage. Lien theory, Florida, which is one where you own your property in Florida and the lender puts a lien. That term, hypothecation, you allow them to put a lien on your home, secure the debt, but you don't have to give up legal title of the property. Title theory, remember under the mortgage title theory, the bank owns the property, okay? There is no mortgage, so the bank owns it. The legal title is in the bank's name, and the buyer or the borrower has equitable title, which means possession, okay? When the loan's paid off, then they convert it to legal title to the borrower. And in the mortgage, you got mortgagor and the mortgagee, okay? Obviously, remember I talked to you about satisfaction of mortgage. There's a letter that comes when the loan's paid off, the lien's removed, okay? So we're talking about a promissory note is the instrument that shows the interest rate, loan maturity, or loan amount, maturity, and all that. And look, payment schedule, all this, again, obligation. It's a contract. It's a financial contract. All right. If a $5,600 sales commission is split 60-40 between the listing broker and the selling broker, each broker splits his share of the commission 50-50 with the respective listing and selling sales associate. How much more will the listing broker earn from the sale than the selling broker? Okay. So another example, you know, how you're going to have to unpack this, right? Get your sheet of paper out, and here's how we work this. All right, so I wrote the problem down again, and I'm going to go line by line. So I got a $5,600 sales commission. That's my total commission. Both to listing and selling broker. They're going to, in other words, they're going to get a co-op agreement, a split between that. That's my total. Okay. Now, they're going to do a 60-40, so all I got to do is take the total amount times 60%, total amount times 40%, and put it to the respective broker. Now, each of them have to share it with their sales associate 50-50. So I'm going to take whatever listing broker agreement to the selling broker agreement, 60-40, and then divide that by 2. That's what goes to the selling agent. Now, watch this. What I want to know and what the question is, how much more will the listing broker make? Because remember, the listing broker is getting 60%, right? So how much more is he going to make is going to be the difference, okay? $560, all right? All right, a 15-year-old entered into a contract with a man who is of legal age to contract. Which statement is true? A 15-year-old entered into a contract with a man who is of legal age to contract. Which statement is true? You got to go back to your contract again. What makes a valid contract? We talked about legal age, sound mind, offer and acceptance. Got to be a legal contract and consideration, right? Here you have a 15-year-old who entered into a contract with a man who is of legal age. So is it considered a void contract? Can the teenager choose to divest herself or her obligation under the contract? The teenager is obligated to honor the terms of the contract. The man may divest himself of his obligation under the contract because the contract is invalid. So what do you think the answer is? And this question is kind of it's a little bit of a tricky one, okay? Because we know in contract law that a void contract, if it doesn't meet the essential elements, one being incompetent and the other one being a minor, it's a void contract. And that's one of the answers, right? So that's not a false statement. But what precludes that, let me show you an interesting point I want to make here, and you want to be ready for this. Remember, a void contract, and we're talking about the legal status of a contract, no legal effect, if you look under one, under void, no legal effect due to not meeting the test for a valid contract. We talked about that. Missing an essential element, offering acceptance. Voidable appears to be valid, but one party can disavow due to the disability or contract disability, through duress, coercion, fraud, okay? Party who has cause to disaffirm may elect instead to perform the contract. And under number 4, a minor may choose to divest themselves to the obligation of the contract. Okay. Now, what we're talking about here, and really what the law says, is yes, it is a void contract because it's missing the essential elements. However, if the minor wants to divest themselves into the obligation, they can continue under contract. Okay. And so it's kind of a weird question. I don't know if you're going to see such on the licensing exam, but just understand one thing. Don't take not into consideration what defines under contract law what a valid contract is. It meets the principles of competency, legal age, sound mind, meets the principles of offering acceptance, legal description. It's legal. It got consideration. Any absence of that would be a void contract. Okay. However, if a minor is in a contract, yes, they are in a situation where they can disavow themselves and exit the deal without being penalized under default. Okay, because the law says they're a minor. However, if they want to divest themselves and continue on, they can do that in respect to their obligation. And that's what they're saying here. So the answer would be answer B. Okay? Keep that in mind when you see that on the test. It's kind of a tricky one, but you got to keep that in mind. Okay? Which business entity would obligate all principals as personally liable for organization incurred debts? Now, we talked about this in the business entity section. Okay? We just visited this. So we're talking about a business entity that obligates liability for organization incurred debt. Okay? Remember, we visited this about probably half a dozen slides ago when it came to the real estate brokerage entity. You remember we kind of visited the general part of a general partnership. You remember that? We said general partners are liable for debt, are liable for the operations. Limited partnership, the general partners are liable, but the limited partners aren't liable, right, for the debt. So in this case, what meets this definition is answer C. Good, very good. And so just in review, just to kind of go back over a few things and just kind of refresh, let's keep our skills honed here. Business entity, when it comes to licensing and registration, remember, under the general partnership, you got to have at least 2 general partners. They are both, if it's just 2 or more, however many they are, but you have to have a minimum of 2 general partners. Under a limited partnership, you have to have at least a minimum of 1 general partner and 1 limited partner, okay? So in general partnership, at least 2 or more general partners, they're all responsible for debt and liability of the operation, taxed individually. Got to register the partnership under DBPR. Forgot the R, but that's what it's supposed to be, DBPR, under the partnership name. And then when it comes to real estate, remember, just in review, at least one of the general partners has to be an active broker. anyone serving the public in a real estate activity level for a commission must be a broker, okay, to be a general partner. All right. And then anybody that's non-licensed, inactive, doesn't fit the role of real estate activity, but may be taking on employment roles like a straight employee, like an administrator, an accountant, whatever it may be, non-related to serving the public for real estate activity, must register with DBPR as a general partner. But they can be, and you know what? There's many real estate companies around the United States that have ownership. They're not even licensed, right? So in Florida, if you form a general partnership and it's a real estate company and you're not licensed, you can't participate in real estate activity, obviously, in any form at all. But you have to register with DBPR as a non-licensee as part of the general partner. And then sales associate, broker associates can only be independent contractors. Okay, with they can't be part of the partnership. And then there's a replacement of the active broker in the office done within 14 days, or partnership registration will be canceled. All licensee within the partnership will be placed on involuntary active. So it's a 14-day replacement rule that they have for general partnerships. So remember that for the license exam. You may have a question that talks about broker replacement, 14 days, okay? All right, so we wrapped up with business entities, licensing and registration. We talked about general partnership. So the question is, which business entity would obligate all principals as personal liability? In other words, liable for organization incurred debt, and obviously it's general partnership. Okay. Next question. The practice of using 5 or 6 model homes to sell houses in a subdivision is associated with what? Because there's 3 types of homes that we're going to look at. And I'll give you this much of a hint. Tract homes, spec homes, or speculative buildings, and custom buildings. Those are the 3 types. Which one of these 3 fit 5 or 6 model homes? Okay. All right, let's look at this. This comes straight out of chapter 1 in your development and construction context. Again, construction improvement of the raw land with a building. And this is what's considered the types of residential constructions that you will see on the licensing exam. Not necessarily all 3 of them, but they could pull one question, and not just the tract homes, but they could pull one of these questions. So let's go through this real quick. A spec home is a smaller scale, spec small, spec smaller scale home, upwards to 2 or 3 homes built by a builder at any one time, right? No more than that, small scale, spec homes. And then, of course, buyers will come by. My daughter lives across town, and I was visiting her last year, and a builder came in and cleared 4 lots and actually had 4 homes going up simultaneously. And of course, those homes are finished now, and they've got occupants in there, owners. But as they were going up, there were just 4 homes. So that would be considered spec homes, okay? So drive-bys, or they could list them with a listing broker. But they're small scale, not the house being small, but the number produced, right? Number built. Only up to 3 or 4 homes. Tract homes, different story. This is where a developer will come in, lay an infrastructure out, and has maybe plans for 6 or 7 model homes, okay? From single-story design to multi-story, 2-story design, different types of 2 stories, different types of single family. And what they'll do is they'll come in, watch this, they'll build the office first, the sales office, okay? And it will be one of their floor plans. The sales office will be a floor plan. But they'll convert the inside into an office. And then they're going to, next to the office, they may have 3 or 4 or 5 or 6 model homes of different models that they will build for you in that development area. And they'll stage them with furniture and stuff like that. So we're talking about tract homes. This is large scale, could be upwards 300 homes, okay? And this is what includes model homes. And then obviously a custom home is a buyer wants a specific floor plan, will hire or contract out a builder to build that one floor plan. So you want to break these down and understand the vision of these, right? Spec small, volume-wise, up to 3 homes, okay? No model homes included in the specs. Track, think of, if you want to think of it as railroad tracks, they go a long way. So you got model homes, right? Track homes, large scale, volume-wise. And then custom home is just per individual basis, okay? All right. 3 persons were co-owners of a parcel of real property. One owner died and his ownership passed to the 2 remaining co-owners. The deceased owner was what? Again, you got to look at this question and unpack it, right? What are the key terms we're looking at here? Well, we got 3 people that co-own. So we're talking about concurrency ownership or co-ownership. One owner died and his ownership passed to the 2 remaining. So that defines what? A right of survivorship, right? So I'm dealing with co-ownership, right of survivorship, and the one that died is considered what? Well, we know tenant at will under A has to deal with a lease. Tenant in common is a type of co-ownership, but does it deal with a right of survivorship? The answer is no. Tenancy by the entirety does deal with a right of survivorship, but it only is with husband and wife, only husband and wife. This is a 3-person co-ownership. 1 person dies, so they're considered a joint tenant, okay? Joint tenant is what we're looking at here. Don't confuse this with tenancy by the entirety. Watch this. Tenancy by the entirety and joint tenant follow the same principle of the right of survivorship. Here's the difference. Tenancy by the entirety, husband and wife, no more. It's not boyfriend, girlfriend. It's not 2 cousins. It's not a father, daughter, 2 friends. It's husband and wife by the entirety, but has the same principles that joint tenancy has, right of survivorship. So if one spouse dies, the other spouse, surviving spouse, gets total ownership, just like it would be. And then they would own in severalty, okay? A joint tenant or a joint tenancy is 2 or more, and it can be any variance. It could be father, daughter, boyfriend, girlfriend, 4 cousins, whatever the case may be. So tenancy by the entirety and joint tenancy are the same principle. They follow the same law of right of survivorship. Tenancy by the entirety, only a married couple, husband and wife. So if you don't see anything involving a husband and wife, can't be a joint can't be a tenancy by the entirety. Okay. So a joint tenant. And this is what we explain. If you want to take a shot of this is what we explain here when it comes to tenancy in common and joint tenants. And it's everything I just explained to you. Okay. Remember, one thing you want to make a note of, tenancy in common gives the best protection to the families. It gives the best protection. Why? Because the person who owns that portion as a co-owner can write a will to their family member. A joint tenancy gives the least protection because their portion goes to the remaining surviving members or partners, okay, in the co-ownership. All right, the term mill is most frequently associated with what? It's pretty easy, straightforward. The term mill is mostly associated with what, or frequently associated with what? All right, so let's talk about a little bit about circle around city and county property taxes, right? So what's the purpose of determining a just value or an assessed value? Remember, property appraisers will use 3 approaches when they go out and appraise property for the assessor, okay? They can use sales comparison for residential, cost depreciation for those special purpose buildings that pay taxes, or income approach like apartment, more than 4 units, right? Now, there is under A2 a term called trim or truth in millage. That is the actual report that's mailed out. That's the millage report that's mailed out around August, September, okay? So the tax rate is going to be used to determine the property tax, okay? 1 mil, by definition, is equal to 1/1000th of a dollar. 2 mils, 0.002, okay? 3 mils, 0.003. I got too many decimals there, okay? So it's supposed to be 0.001, okay? 1/1000th of a dollar. Now, the local importance of, when it comes to property tax, is what? That's the primary revenue that it creates for law enforcement, fire, other services, okay? Ad valorem is a term used according to value. In this case, we're talking about assessed value. A value according to a value, in this case, assessed value on what's going to be taxed, okay? And then we know assessed value, the county appraiser it will determine that through the market value that the appraiser gives them. Under B4, A, B, and C, you got to know this for the state exam. November 1st is when everybody is eligible or becomes available to pay their property tax. January 1st, if it's not paid by January 1st of that next year, there's a lien placed on the property. And if it's not paid by April 1st, it's delinquent and goes to a tax sale. You got to know those 3 dates and specific definitions with them. Okay. So we're talking about tax rate. That's what millage is associated with. Okay. All right. A lot is 180 feet by 225 feet. The city is assessing all lot owners on the street based on $24 per foot for paving. The city has agreed to pay 30% of this paving cost. What is the paving assessment for this lot? Okay. Okay. All right. Let me just go over a couple of points when it comes to this type of problem on the state exam, right? This is what they call a special assessment, all right? What's a special assessment? Does it involve everybody? And the answer is no. Everybody, watch this, everybody must pay property tax, okay? And let's just use in generality all residents, commercial buildings, all that, okay? Everybody pays property tax, owners. Not everybody will pay a special assessment. For example, if there's paving going on in your side of the town that you live on that affects you day in and day out, then that assessment will be applied to you and not me on the other side 20 miles away where I don't even use it, okay? So understand the principle of a special assessment is a tax, does have a superior lien position, just like a property tax does if it's not paid, okay? So a lot of times you'll see property tax / special assessments hitched together. And they are hitched together because it's enforced by the county and city on property tax, 1, and on special assessments, in this case, road paving on a special area, okay? So that's the principle of special assessments. Now, when you see this type of problem that deals with paving, it could deal with sewer lines, whatever it is that affects an area, and in this case, paving, it's a road. You got to realize when you break this out or unpack these numbers, they're not asking for a length times width, 180 by 225, okay? All right, this is a linear cost because it's a road, okay? So a lot that's 180 by 225 sits on a road that's going to be paved. This lot, watch this lot by itself has 180 feet of that paved road that they're responsible for. That's the frontage. That's the front of the lot. So the 225 or the depth of the property doesn't even involve the problem. Okay. So if I take 180 times $24 per foot, I get a number, a total cost, for mine. Okay. Now, the city government, and we call the city, we'll call it a government controlling agency, has agreed to pay 30% of that total cost of 180 times 24. So I'm going to subtract that out. Now watch this. This is something I want to teach y'all on testmanship, to look out for this on the state exam. Again, special assessments, one time, it's not done each year. It's just a one-time tax levied for public improvements. Anytime you're dealing with a street assessment or a paving assessment problem, it's a front foot basis calculation. Okay. You're going to calculate the front footage times the cost per foot, subtract the amount the government's going to pay. Don't forget to divide by 2. I'm going to show you why. Again, special assessment liens go to first priority. All right. Here's an example I drew up for y'all. The road at the bottom, a paving road. So I put the question back in there. Again, we're going to unpack this one line at a time. I get my paper out. Step 1. I'm going to calculate what the total cost is. So it's 180 times 24, which is 4320. That's my total cost. For my front 180 feet, I'm responsible for $4,320 of that budget that takes to pave that whole road. Right? Now, the city or the government agency is going to take 30% of that. They're going to pay $1,296. Very nice of them. Appreciate it. They're going to discount me. So I'm going to end up paying $3,024. They put, which is a true answer, but it's not the answer they're looking at, because you got to take it one step further. Why is that, John? Well, if you look at my picture down at the bottom, let's say, for example, if it were possible, now you got to work with me on this. You live on the right side of the road. I live on the left side of the road. We both have 180 feet of frontage. Do you think I've got to pay for your side and you got to pay for mine? And the answer is no. So what happens is, don't forget to do this. You're going to take that total cost and you're only going to pay for your half. So you got to divide it by 2, okay? Which brings you to a cost of $1,512, okay? Yeah. You got to subtract the $1,296, 30%. This is why everybody pay attention to this. This is a good learning moment. You go step by step. You can see how the problem I got right there, it's a 3-line problem. I got 4 steps. And I went line by line. I calculated the front footage cost. And then look at the next line. The city agreed to pay 30%. So I took for 30% of that total cost on step 2. And then I got to calculate, if they took that cost away from the total, that's how much I got to pay. Total I got to pay is $3,024, but that's the cost of both sides of the road. So I'm only responsible for half the side. Okay, so it'll be $1,512. Remember the paving. Don't forget to take it that extra step and divide by 2. All right. All right. Which encumbrance constitutes a lien on real property? Now, y'all remember encumbrance, right? Encumbrance can come in many forms. Remember, it's a burden on the property, but it can come in many forms. It can come in the form of liens, easements, right? So which encumbrance talks about a lien on real property? What do you think that answer is? Which encumbrance constitutes a lien on real property? Okay, we're talking about a lien. Remember a lien. Remember in finance, what did we say a mortgage was? A lien. Remember, a lien is something, it's an encumbrance. It's a type of encumbrance. A lien is an encumbrance that secures a debt from somebody. Is it a restriction? No. Is a lien an easement, mortgage, encroachment? Not an encroachment, not an easement. It's a mortgage. Remember, a mortgage, watch this. Everybody look up here at the screen. When we talk about liens, we're talking about someone that's securing a debt. A lender will put a mortgage as a lien on the property. They lent you money, so they want to secure their debt. That's called a specific voluntary lien. Remember those 2 terms. Specific in general, voluntary, involuntary. Specific voluntary. Why? It's specific to that legal description, the home, It's voluntary because you allow it. Okay, specific voluntary, and it's a lien. They're securing their debt. Now watch this. Mechanic's lien or a contractor's lien. Someone puts in a pool. You don't pay them a full, they put a lien on your property. Again, specific, involuntary, because you're not agreeing to it. Okay, you're not agreeing to it, right? Otherwise, you would have paid them the full amount. So they had to file a lien to get full payment. Okay, so it's specific to the legal description, but it's involuntary. Okay, mortgage is specific and it's voluntary. Okay, so liens satisfy debt. Judgment lien, again, specific to an address. All right, tax lien specific to an address. Right, didn't pay property taxes. Involuntary, it's not agreeable. Okay, so you got to ask yourself, is it specific to an address or not? Is going to define a specific lien versus a general lien. An income tax evasion. Someone doesn't pay their income tax. Okay, that is a general lien. Okay, that can go on multiple properties if you have them. Okay, so a lien is an encumbrance that's placed on the property to secure debt. Any type of debt. It could be a mechanic's lien, a judgment lien, tax lien, anything to secure money that has to be paid. And unless that money's paid, when the house is sold, they're going to take it out of that. Okay? That's what liens are designed for. So we're talking about a mortgage here. All right. So ownership, limitations, and restrictions. Again, I kind of just went over this, but just kind of in review. Lien gives under A is a creditor's right to secure debt. Okay? Liens, mortgage, mechanic, judgment, tax liens. We just talked about. Two types, voluntary and involuntary. Property owner agrees to it. Involuntary, either created by law or disagreement, doesn't agree with it. Okay, property tax lien, for example. And then you got general and specific. Okay, remember, specific to the legal description that the lien's put on. General is general to all properties. Okay, when you look at easements and restrictions under number 3, those don't fit into the definition of a lien. That has nothing to do with a lien that secures debt. Easements, although an encumbrance, both are encumbrances, and the easement has to deal with the right of somebody crossing your property to get to theirs. Okay, and then a restriction, limitation on the use that's imposed by, could be deeds, zoning, statutes, state statutes, or public regulations. Okay. So the concept of ownership, limitations, and restrictions fall into many categories. Under the term encumbrance, you have liens and you've got easements, okay, and restrictions. Okay. Which statement is true with respect to closing statement entries? So we're looking for A, B, C, or D. Which statement is true? Now we're talking about a closing statement, okay? A CDF, closing disclosure form, or closing statement. So under this category, you just have to know what is a debit to the seller and a credit to the seller. What is a debit to the buyer and a credit to the buyer? Okay, this is what they're asking you here. So let's just go over this because this can be, this will make you look cross-eyed. So here's a rule of thumb. The general rule of thumb, when it comes to credited to the seller and a debit to the seller. Okay, so a credit to the seller is a selling price, prepaid, any type of items that are prepaid in advance for proration, tax, utility, insurance. A debit would be the actual payoff, right? Interest on an assumed loan, prorated taxes if they're paid in arrears. Remember, whoever pays the, proration items like taxes, HOA, if they're prepaid, then the seller is going to get the credit. If they're paid in arrears, the buyer will get credit. So whoever pays for it is going to get the credit. And now credit for the buyer, the new mortgage amount, assumed mortgage, earnest money. Earnest money is the answer that fits this definition or this problem as far as the closing disclosure form, the closing statement. So earnest money is a credit to the buyer. Remember, that earnest money is a deposit that was paid well in advance when they went under contract, and it's held by the listing broker in escrow. So when they go to closing and apply it, they're going to apply it to the credit side of the buyer. Okay. So the answer is B. Earnest money deposit is entered as a credit to the buyer. All right. The maximum payment for the real estate recovery fund for a judgment. The maximum payment is issued in connection with a single real estate transaction. So per transaction, they're asking per transaction. All right, so again, kind of circling back to the recovery fund, what's it used for? To reimburse consumers. Remember, the agent, the licensee has to go last resort. They have to pay for it. If they can't, then they can go to the recovery fund. They're suspended until it's repaid. $50,000 per transaction, $150 maximum they'll pay out. Okay, so per transaction is what the question was talking about. Okay, active licensee has to be an active licensee at the time. not a principal or owner of the business in which there is a purchase, sale, or lease in the transaction. The licensee was acting solely as a licensee in the transaction, and a spouse that's represented by a licensee doesn't qualify. Okay, so $50,000 per transaction. All right, which valuation must conform to USPAP? Remember, this is a valuation / appraisal term. Remember the FERIA and USPAP, those are regulations and federal acts, state acts, regulations that appraisers must follow. Okay, so what valuation must conform to USPAP? I gave you the answer. Okay, good. All right, so let's talk about the appraisal. Again, the process of estimating a value, and I'm going to circle into this to give you some more insight that you may see other types of questions. When we talk about appraisals, you got to be a licensed appraiser to conduct any appraisal that deals with anything federally related loans, okay, and or government requests like eminent domain, okay. You got to be a licensed appraiser. So FHA, VA, conventional, or any government request, got to have an appraisal license. Now, under Florida Statute 475, a licensee, which you will become, a licensee can appraise property, okay? They cannot appraise property that falls under the category of a required license. Federal-related loans and or government requests. A licensee can't do that. So a cash deal, for example, or someone that just calls you up and said, hey, can you come and appraise my property? Now, here's the other requirement for a licensee to be able to appraise a property. They must conform to the uniform standards of appraisal practices, okay? They got to use their method, their forms, and their procedures, okay? So one more time, an appraiser has to be licensed to appraise property that are federally related with mortgages, a loan, and or government request. Under 475 Florida statute, a licensee can appraise property outside of the federal related loans and or government request, but that licensee must conform in the appraisal the method used in the uniform standards of appraisal practices, okay? If a Florida licensee does appraise property outside of the guidelines, outside of, a federally related type loan or government request, they still have to go by USPAP regulations, okay? All right, a grandfather clause in a zoning ordinance probably would allow an owner to do what? So you have to understand the term grandfather clause. They use that in the example, but the book calls it non-conforming use. Same term. This is more of a slang term. But what can an individual do if they are in a grandfather clause when it comes to zoning? What are they allowed to do? They're building. Out of these three answers, what's the one they can do without having to reconform to the current code? Okay. Right. Basically, if you alter the building, okay. Now, if you're just changing things out, flooring, roof, that doesn't constitute breaking out of the grandfather non-conforming use. Okay. So answer C would be it. So here's the way this works when it comes to local zoning terms. If you come down to number 3 first, you see having a conforming use or a grandfather clause means the building's been there for some time, could be decades, and the zoning wasn't as restrictive as it is today. And so today, if they redo the building, expand it, tear it down, rebuild, then they have to go with the current code. But as long as they don't do anything to the building, but just, maintenance, change things out, then they're able to stay in the original code that they built decades ago, for example, and that's called non-conforming or not conforming to today's use. That's the way I look at it, right? And then you got a term called variance. You may see a test question on variance. This is nothing more than bending the rules. It allows the owner to vary the property, again, against the zoning code. Got to be some type of hardship that exists, but it wasn't created by the owner, okay? Use will not change the essential character of the area, and it doesn't conflict with general intent of the ordinance. Special use or a conditional use permit, this is nothing more than taking a certain zone and being able to use it for something other than what that zoning restriction allows. In other words, special use. I like to use an urgency care center, maybe put in a building where there's residential zoning. Okay. In other words, and I've seen that before. Actually, a veterinarian clinic I saw that was built almost like the first house just out into the entrance of a subdivision is a veterinarian clinic, right? Be an example, or an urgency care center, maybe zone residential, but they can get a special use permit. If you break the condition, you lose the permit. Okay. Anytime that you alter the property, so adding an addition, whatever, in other words, you're altering the property in a major way, would definitely require bringing it to current code. Especially commercial property. I had an example. I don't have it here, but I have an example of a property of a gas station. The old, you saw Back to the Future. You remember the gas station scene, the Texaco? We had 6 people come out and service the car, the old style with 2 bays. If you got one of those today next to one of what they call a Buc-ee's down in Texas, these things are like Walmarts. They're travel centers, but they're as big as Walmart with a gazillion pumps, right, to pump gas, and they've got everything in there, right? It's almost like a Cracker Barrel, the store part of the Cracker Barrel, but it's the size of a Walmart. I mean, these things are huge. And so you may have one of these old style, type gas stations next to a current one. Well, if this old one was there and it's 4 generations, it's been there for, 60, 70 years. It was built during different zoning, right? Code was different and restrictions were different. Well, it conforms to the old code, non-conforming to the current code, unless it's altered. Okay, so if you add to it or alter it in any way, then it's going to have to get approval for the current zoning. Okay, changing a roof out doesn't alter the property. All right, an owner developer employs 5 licensed sales associate, pays each sales associate a commission for the sale of owner developer lots, which is true of the owner developer. So as a licensee, you can work for a broker or an owner developer. Okay, can't work for a broker during the week and an owner developer on the weekend. Okay, so if you are a sales associate and getting paid a commission by an owner developer, what must that owner developer do? Remember, owner developer doesn't have to be a broker. The owner developer doesn't apply for a multiple license. The sales associate would, but not the broker, not the owner developer. And the owner developer may only pay the sales associate a salary. That's not true. They can pay them a commission because they're licensed. What the owner developer must do is register with DBPR, but they don't have to be licensed. Okay. Again, under sales and leasing, you got broker and owner developer. You can only put your license under one. You can get paid a commission by both. Okay. Anybody that works for an owner developer, you could have someone working next to you that's not licensed. They're paid a salary by that owner developer, but you get to be paid a commission. The owner developer must register with DBPR. All right. If a tenant legally subrogates, or subordinates the rental space, what does that mean? Subrogate or subordinates the rental space. Okay. So let's look at this definition. When we talk about subrogating, we're talking about subletting. Okay. So it's a sublease. And basically, if you look at the gold box, when you sublease, you're going to only partially lease out. So you're going to still occupy the home, but you only may lease out a bedroom. If you assign a lease, that means you're going to leave the entire property and you're going to assign the whole lease to someone else. Both subrogating or subletting and or an assignment of lease requires permission of the owner. Okay. So that's what it means to sublet or subrogate. Assign a partial. Okay. Could be a bedroom. If you're paying $1,000 a month, you may sublease a bedroom out in part of the common area, the kitchen and living room. You may have them, pay $450 if you got the master and the master bath, so you're going to split up the actual rent between the two. That makes sense. But sublease, subrogate versus assignment. Okay. All right. What did a new home cost if the state documentary tax on the deed was $546? Okay. You got to work this one out backwards, and you got to understand what a documentary stamp tax is and how to figure out this 546. So let's look at this. So a documentary stamp tax is paid by the seller, 70 cents on each stamp. So you're going to take the sales price, divide by 100, times 70 cents. That gives you the documentary stamp tax. Well, if the stamp tax is $546, I'm just going to work it in reverse. Okay. I'm going to take 546 divided by 0.70. That gives me 780 stamps multiplied by 100. Remember, I'm dividing by 100 to calculate the other way. I got to multiply by 100 to get my price. So it's 78,000. All right. So 78,000. You just got to work in reverse, but you got to understand documentary stamp tax. You got to understand how to get that $546. Okay. And just work it in reverse. All right, which statement is true regarding a real estate sales associate who's convicted of DUI? This comes straight out of the 475 statutes. Let's go ahead and we're talking about a licensee, not an applicant, a licensee who's been convicted of DUI. Okay. And so here's what has to happen. So under penalties issued by a court of law, okay, criminal penalties, we see second-degree misdemeanor, first-degree misdemeanor, third-degree felony. Those are different penalties that can be associated with a licensee. Civil penalties are violations of statutes and actually administrative codes imposed by a court of law. Okay. Now, in the green box, make a note, the licensee, any licensee has to report to the commission within 30 days of a plead of guilty or a nolo contendo in a court for any misdemeanor or felony, regardless of where it took place, even if it's out of state. Okay. So in this case, a DUI, they have to report it to the commission within 30 days. Okay. So any plead of guilt or nolo contend for a misdemeanor or felony must be reported to the commission within 30 days, regardless of where it occurred. Okay. All right. A broker agreed to pay a sales associate 45% of the total commission. Property sold for $320,000. The commission rate was 7%. Property was sold in-house. What was the broker's share of the commission? Just like I've been teaching y'all. Unpack this one line at a time. Okay, so I got the problem on the next page. So here's how this works. Okay, I'm going to go line by line. What's my total commission? That's the sold price times the commission rate. So I know that the property sold. Remember, you could have it in there, a list price, etc. It's sold for $320,000. Okay, the total commission is 7%. Okay, so my total commission is $22,700. Now, the broker agrees to pay his sales associate 45%. Okay, so the sales associate receives $10,080. Okay, so the broker's commission is going to be the total minus the sales associate. Okay, or you could take 55% times the total and get the same number. Okay, 22,000 minus what the sales associate was paid. All right, or you could multiply 22,400 times 55%, which is the broker's take. Okay, either way, so 12,320. All right, a joint venture usually is created to what? This comes out of the business entity, all right, general partnership, etc. So when we talk about joint venture, what are we talking about? When we talk about joint venture, what are we talking about? Let's talk about this real quick. All right, this comes under business entities, all right? So now, I want you to understand this definition under the title business entities. These are entities that may not be registered as a brokerage with DBPR. Remember, general partnership, limited liability, limited partner corporations, all those are registered with DBPR as brokerages. These are non-registered business entities with DBPR, okay? Non-registered, okay? Corporation sold. Okay, we're talking about church offices, maybe held by a bishop or other type of church officials, and that's SOLE. Joint venture, this is the one we're talking about. This is where two or more people carry out only a single business activity, or in this case, carry out a single project. And then you got a business trust and a co-op association and an unincorporated association. Okay, so 5 business entities that are non-registered with DBPR, okay? And there's a difference between those that are registered. All right, which activity is not a real estate service? All right, so this kind of falls under, and if you want to take a snapshot of this, memory aids, they work. Talking about a bar sale, this is what Florida acknowledges as activities relating in Florida to real estate. Advertising, buying, appraisal, rent, or provide rental information or list. Selling, auctions. You got to be licensed to be an auctioneer when auctioning real estate. Any type of leasing and or an exchange, which is under the IRS code, 1031 exchanges, okay? So you want to know a bar sale. The one that doesn't fit this definition that was an answer is answer B at the top left, the mortgage, okay? That's the lending side, okay? So advertising, buying, appraising, dealing with rental lists. You got to realize Florida, from Pensacola all the way to Tallahassee, hang a right, go south down by Sarasota, back around the tip of Key West, up the eastern seaboard to Daytona, right to the Georgia line, is the most beaches, usable beaches. You know, there's some restrictions, you know, due to the environment and birds and all that, but most of the beaches, you don't have that in California. A lot of it's cliffs, right? You don't have that in Hawaii. These are the most beaches that are used, and they're lined with beach homes and condominiums all the way around, if you look at a map. So when we deal with rental lists, property management, rental lists, and remember, that's a misdemeanor, right? There's a penalty if one hands out a bad list, right? So you want to know a bar sale. These are the real estate services that apply to Florida. You want to know this for the state exam because you'll probably get maybe 1, maybe 2 questions on that, okay?
For more practice questions, videos, and insight into the state exam, we encourage you to join our free exam prep webinar, How to Pass the Real Estate Exam Without Your Real Estate Book and with only 15 to 20 hours of study time. Click here to get registered.